welcome you all to this webinar series on access to finance, exploring the funding options and the eligibility criteria for your agri-projects. I'm here accompanied by Thomas Kimani and Harrison Odongo from AfriScope. They will be the experts leading this webinar. Thomas, the floor is yours.
So to start, what are we going to cover today? We're going to introduce the topic. Brice will take us through the introduction, and then we'll go through a quick understanding of the funding types and instruments, and then how to be eligible for these instruments and the options which are out there. And then we'll summarize this and show you the next steps that you can take as an enterprise that is looking to grow and access financing. And finally, we will close with a Q&A session. Our session for today are just you all business people, time is money. The first 10 minutes we'll take them on introduction. And from there, we will have a session where we'll talk about the funding instruments and what they are, the types, and what are the different funding instruments in the market today. Although this instrument may vary from market to market, there is just a general concept of what is in the market today. Then we will tackle, for these instruments, how do you become eligible? What do you need to prepare for each type of funding? And finally, we will close it with a summary and next steps so that we can know, after all this training we have gone through this session, what next steps should I take as a businessman, and how Collead and its partners has availed tools and resources to go sharpen your skills to ensure that you are able to tap into these funding opportunities. To start, I think I'll hand it over to Brice to take us through this introduction session. Brice?
Thanks a lot, Thomas, for introducing the session. It's a pleasure for me to also contribute to the introduction. My name is Brice Moureau. I am the Access to Finance Manager here at Collead. First, a slide on Collead. For those of you who do not know us by now, Thomas, you can move on to the next slide. So who is Collead and what do we do? Well, Collead is a not-for-profit private sector association with over 50 years supporting the horticulture sector in the ACP countries. We're supporting MSMEs, competent authorities, consultants, etc. We are a company of 80 people distributed among 4 offices in France, Belgium, Kenya, and Togo. And we've been active for the past 20 years implementing development programs for our main donors, meaning the EU Commission, the OEACP, the AFD, UNIDO, etc. Our mission, as you can see it on the slide, is to facilitate and implement all actions allowing directly or indirectly to increase the contribution of the agricultural sector and horticulture in particular to the achievement of the Sustainable Development Goals. So we're both a network and a toolbox, a network of more than 500 members that are active in agri-value chains from private sector and public sector, a network also of more than 1,200 experts that can help you on all topics: business, plant health, certification, production, etc. We're also a toolbox. We provide technical assistance, we provide trainings, we provide tools. Today, we will show you a bit of what we do in terms of business and access to finance. So it's important for you to remind that Collead can help you on whatever potential problem you might face as an organization active in an agri-value chain. But today is about access to finance. So if we go to the next slide, we all know that access to finance is an enormous problem in the agricultural sector. And this is why Collead has been supporting MSMEs in their quest for external funding for years by now. As you know, you need to be investment ready in order to successfully secure external funding. And to become investment ready, you need to check a certain number of boxes: having a valid business model, having a robust business plan, a financial plan, and then only identify and engage with sources of funding. Not everyone has the same maturity in terms of investment readiness. And this is why, in order to help our partner beneficiaries check those boxes and secure funding, Khalid has developed a series of training materials structured along an investment readiness path. This path is the one that you see on the slides. So based on your maturity, you can choose the training that will help you reach the next step. Today's webinar is designed for organizations who are already at step 3, meaning they have a valid business model. So you're making money for at least 1 year, for example. You have a robust business plan. A robust business plan is a document of minimum 10 pages where you describe your plan for growing your business. And you also have a financial plan. So realistic financial projections that are backing your business plan in an Excel file. So for those of you who do not yet have all those business model, business plan, and financial plan, good news. Our training are already online and they will help you reach this point. You can see in the chat a document with the links to the various trainings that we are offering. For those organizations who are already there and ready for matchmaking, you are at the right place. We've developed a series of 4 webinars that I will quickly introduce in the next slides. So why a series of 4 webinars just on matchmaking? Well, because identifying the right source of funding, as you might have experienced, is both important and complex. This process can be summarized in 4 steps. For the first steps, we already had a webinar in June presenting 4 platforms where you can find sources of funding focusing on the agri. But we realized the audience was left with one question. Okay, once you have those lists of sources of funding that are available in your region, it's very hard to understand who they are and what they offer and how to engage with them. This is why we came up with 3 additional webinars. The one of today will focus on understanding what are the various funding instruments and what are the eligibility criteria of those instruments. The next one in February will focus on how do you choose the one that is most relevant for your personal needs, so for your agri-project. And then the last one will give you the tools to successfully engage with the source of funding that you'll have chosen. Back to today's webinar. You've heard me mentioning already several technical terms like source of funding, funding type, funding instrument, and funding options. It's very easy to get confused with those terms. So what is the difference between them and how do they relate with each other? Let's take 2 minutes to define them very clearly. First, sources of funding. So sources of funding are organizations providing various funding instruments to finance agri-MSMEs and their activities. In this category, you can find banks, microfinance institutions, impact funds, NGOs, etc., etc. This is for sources of funding. You know them already. Now, each source of funding offers various funding instruments. This is the second important concept. A funding instrument is a specific financial product or tool used by sources of funding to meet agri-MSMEs' financial needs. So in this category, you can find trade credit, credit lines, convertible debts, quasi-equity, seed grants, etc., etc. Those terms we will explain in depth today. Now, each funding instrument belongs to a certain funding types. You have 4 main funding types: internal financing, debt, equity, and grant and subsidies. What is a funding type? Well, this is a broad category of financing instruments based on the structure and the repayment expectations. So you have a little diagram there on the right-hand side to understand how they relate with each other, but let's take a concrete example. One specific funding instrument, for example, a short-term loan of 50,000 US dollars, belongs to a certain funding type. Here, a short-term loan is a debt, okay? Now, it also comes from a certain source of funding. Here, a local bank, for example. So this short-term loan, which is a debt coming from a local bank, represents a funding option for your agri-project. And how are you going to use it? For example, to finance your inputs. Okay, note that those 4 terms are clear. If we summarize, identify the right funding option for a business is useful and can help you in 3 main ways. So basically, this slide is about why is it important for you to spend 1 hour looking at this webinar. First, understanding what is the right funding option for your business will increase your chances of securing funding, so of reaching this funding. For example, if you do not have a collateral, it will be hard to secure funding for a long-term loan, for example. And again, if you don't understand the term collateral, stay with us because we will explain what it is. The second main reason why it's important to identify the right funding option for your business is that it will help you find favorable conditions. So, for example, if your business has a high positive impact because you employ a lot of small farmers, well, you might be eligible for an impact fund that provides an interest rate that is more attractive than the one that you might find elsewhere. On the contrary, if you contract with a source of funding that is not aligned with your plans, it might hinder your growth. For example, if you go with an impact fund that will be willing to exit the investment after 5 years and you still need the investment, then you will find a problem. The third and last main reason why it's important to identify the right source of funding for your business is that it will help you leverage extra financial support. So, for example, those sources of funding can help you with extra financial support like technical assistance or maybe networking opportunities, meeting the right buyers, meeting the right service providers. Well, I've talked for too long already, so now that it's clear why identifying the right funding option is important for your project, I will let the local experts speak. We are glad to have had the chance to develop this webinar with Thomas and Harrison. Thomas, again, the floor is yours.
Thank you, Brice, and you've put it so well. I think some people can start leaving now because you have said it all. But we'll dig deeper into all this. We'll dig deeper into all this so that we can leave the audience with something they can take home and something that will build their enterprises. As you've heard, my name is Thomas Kimani. I have worked in, I have experience of over 20 years in different sectors in horticulture, renewable energy, and entrepreneurship. And I think my core competency has been essentially in raising capital and resource mobilization for the agricultural spaces, especially in Kenya and at large East Africa. Again, I'll introduce my colleague, Harry. Harry?
Thank you so much. Thank you so much, Thomas. Good morning, good afternoon from wherever you are joining us from. My name is Harrison Odongo. I have a background in finance with 10 years of progressive experience in providing business development support that includes, but is not limited to, strategy formulation, market linkages, and most importantly, fundraising for agri-SMEs in the East African region. I'm looking forward for a wonderful and engaging webinar. Thank you.
We'll start by understanding the funding types, as Brice very well put it. So what are they? The first one is we'll go through an overview of what funding types are out there. And then after that, we will come in and go through the types of funding instruments as per funding types that are out there. And now here's where we break it down into what we were calling internal financing, debt. Many people know debt as part of financing. And then we'll go into equity. And finally, we'll close with grants and subsidies. And we understand how each works, how to optimize the use of each in making your enterprises more successful. So as an overview, so we look at the first thing, what are the funding types? And there we have like what we are calling the internal financing. And we are looking at three main instruments under internal financing. We are looking at profits and retained earnings, which are generated by the business, the trade credits, the trade credit you get from your suppliers, and then there are the customer prepayments. All this we can appertain to the reputation or the success of your business. That's why we're referring them as internal funding. So how do we define this as? This is using personal savings and retained earnings to fund operations and growth. Again, this is what the business has developed in the past, and we'll dig deeper into them. And now those are the examples of retained profits, customer prepayments, and credit suppliers. An example we have shown there without going too deeply into it. You're a smallholder farmer group. You want to invest $5,000 of your accumulated funds to purchase, for example, a new irrigation equipment. These are funds which have been generated internally by the organization so that they can hit their objectives as an organization. The next major type is debt. Many times when you talk about financing, many times you just think of debt. So we're going to look at debt from two main perspectives or two main instruments. We're going to look at it as short-term debt and credit lines. And we're also going to look at it in terms of long-term loans, what many people would refer to as loans. Many people just say loans, but it's sometimes difficult to distinguish the two types, short-term, long-term, and credit lines. So we'll go deeper into that and give you the tools to understand which would work best for you. So that's a definition there. Borrowing funds from a bank or any other financial institution or intermediary, and these require regular repayments with interest. Interest is normally a factor. And funny thing, sometimes you can be given at zero interest. There are all these instruments out there as we get to understand them. So that is an example, or rather, those are the relevant instruments. We are talking of trade finance. If some of you have used trade finance, things like letters of credit, where you use to finance business, maybe importing goods from out there. You're talking about working capital loans, where you're looking for funds to maybe pay for a season of employees, casual workers, before you actually sell your produce. You're looking at equipment financing, and then you're looking at asset-backed loans, which are more of a longer term in nature. So we've explained that. I won't go into details right now, just so that we can cover as much as possible in the short time we have. The third type of funding type we'll talk about is equity. And we'll look at it in two ways. We'll look at it in terms of convertible debt or quasi-equity, which is more closer to the debt. This is where maybe you started off as a debt and the people who gave you the money think your organization has promise. So it's right there in the middle between debt and equity, where it can be converted from debt to equity, depending on how they look at it. We'll see the conditions as we move on. And of course, there's direct equity, where investors come in, put in money into your business, and they become part owners of your business. What do we define equity as? Basically, it's purchase of shares or a share of ownership into your organization with expectation of earning a return. Again, many people misconstrue equity as just regular money. It comes with its own conditionalities. So these investors are not putting in there because they love you so much. They're putting in there because they believe your business and they believe their money will have a return. So what are instruments around this equity? They can come in as a direct equity instrument, where we just go and give the company money and I buy shares from the company owners, or I come in and we have a hybridized mezzanine kind of debt arrangement, where you start as a loan and you eventually graduate it into equity, where they will eventually have an ownership in the business. So an example, you sell 10% of your company for $1 million. That is a dream come true. But guess what? The investor will own a piece of your business, a 10% of your business, and will also be part of the decision-making process, depending on how you've agreed on. The final type of funding we will be talking about today is the grants and subsidies. These are sometimes what everybody is looking for, but they have their conditionalities, and we'll dig deeper into them so that you see whether it's really good for your business. We'll be looking at two main funding instruments under grants and subsidies. We'll be looking at seed grants, and we'll be looking at matching funds. And don't worry at this time if you don't quite get the terminologies. We'll break it down as we move ahead. So these are typically non-repairable. Again, that's a beautiful word, non-repairable funds. And most importantly, no interest bearing, because sometimes you can have repairable grants, but these are no interest. So it's essentially, in business terms, free money. But again, we'll see how that works so that we don't rush into getting grants without understanding the connotations. So what are relevant instruments that come with this type? They come as infrastructure grants, where you're maybe putting up infrastructure and a grant maker comes and gives you money to put it up. Maybe it has a community impact or things like those. Or technical assistance. Sometimes the grant doesn't come as physical money. You get experts who are brought in to maybe work in your business, and instead of you paying their salaries, they are paid by the grant makers, and it helps propel your organization forward. And then, of course, there are the matching grants, where there are conditionalities. We will only give you these funds if you show you can provide this or that in kind or in cash, so that the project can take off. So that's a small example we shared there of how this would work. So a 200 grant to build to build a mango aggregation center. So I'll not dive into that at the moment. We'll see it as we go ahead. So to get into the meat of understanding funding instruments, the first one we'll talk about is internal financing, as you saw. And under internal financing, we talked about three main instruments. We talked about profit, retained profit and earning, trade credit, and customer prepayment. Here we start with retained earnings. And you can see the small triangle there. Retained earnings essentially come from the company. So what are they? These are the funds the company has made. You're in business to make profits. You can either take the profits and consume them as shareholders, or you retain them to grow the business. So these are mainly what is retained by the business to grow the business, and you use it to grow the business. So who offers it? Of course, it is the agribusiness itself. If you're making profit, you offer yourself that type of internal financing. So how do you access it? Basically, is for you to understand how much you can fund internally, you need very good financial management practices. You do not want to, what we call locally, eating into your profits or spending the money you'd use for purchasing equipment and other things to fund things which may not work in the long term. So it all runs on profitability. You have to understand your profits before you can have that internal financing mechanism going forward. So what are the advantages? The most obvious one is there's no interest and there's nobody knocking on your door or calling your phone to repay. So we look at the downside. Everything has a downside. So the major downside is it is limited by the amount of profits you generate. I know you work so hard, but again, it is what it is. It's limited by the profits you generate. And this sometimes can restrict growth. You have this idea which needs to be funded like yesterday, but your profits are not just there yet. So that's a major limitation. So what's an example? A farm uses 20,000 of its profits to purchase new irrigation equipment. Moving on, we talk about trade credit. Again, this one is pretty straightforward. This is an arrangement where a supplier of yours, because you've been such a good customer, they give you their goods on credit. Trust me, that is financing. And you pay after a period of time. He has essentially funded your business. So who offers it? You know some of them from your own country. And here we've mentioned a few examples just to understand what it is. It can be offered even from the local person who is just giving you a few days of credit. That is part of internal finance, but they won't finance you unless you're very good at repaying back or you have a very good reputation that you'll generate good returns on it. This one again does not normally have interest. So how to access it? Again, it starts with negotiating terms with your suppliers and then maintaining a good payment history. Payment. If you don't pay, you won't get credit. And then share progressive potential business prospects to entice suppliers. Talk to your suppliers, tell them, look, this month, next month, we are doing ABCD. So they can also feel encouraged and they see, okay, there's a future in this company, they're not going down. So what are the advantages? Again, normally no interest obligations. And then it expands your cash flow. Cash is king in business. It expands your cash flow and resources so that you don't tie unused capital with supplies. What is a drawback? Again, sometimes the period may be too short. Maybe you've not been paid on the other side by your customers, but they want their money back. Sometimes it can strain your relationship with suppliers because of basically that you've not been paid. Where are you going to get money from? And this guy extends credit to you. So the last one is because this supplier is offering you credit, there might be a tendency for him to entice you into this. On the hindsight, he has increased your pricing a bit. So you do your math and see whether that's enough of a disadvantage before you engage. So what's a good example? A tomato growing company receives seeds from a supplier and they give you 60 days before you can repay. What's better than that? These seeds have grown, they become tomatoes, and now you're after 60 days, a little over 60 days, you're selling them as tomatoes. So that's a good way to finance your business. The last funding instrument under internal financing we look at is customer prepayment. Sometimes we overlook this so much as businesses. So what are these? Sometimes your customer can you can receive payment in advance because he believes you are good for the money. You can pay as he's booking for the goods he wants you to deliver. He pays you maybe 3 months in advance, especially in agriculture. I want this piece of tomatoes. I'm preparing you in small bits so that by the time they're ready, I've paid everything. So that helps finance your business from your customers. Again, it's offered by the customers who are out there. And how do you access it? First of all, you have to offer these incentives to your customers. You tell him, look, or you tell her, look, if you get this, if you pay for it now, I will not sell it to anybody else apart from you. And you know me, I'm good for the supplies. So you have to also clearly say the supply lines, because in agriculture, you know, it's about timing, how you time the market. So you have to be very clear on supply lines. Will this customer make money if you supply at a certain time, and that entices him to book those goods, and so that he can be assured that time he'll get the supplies. And again, it works from having good, clear records that support your assertions. And then the last one here is just maintain a positive track record on customer delivery. Again, it goes down to the records you maintain as an organization. So what is the advantage? Again, no interest. In business, interest is a major killer. That's money you're paying out for accessing funds. No interest. It mitigates the risk of customers not paying. Again, because he has prepaid you, what is the risk of not collecting your money? And again, you have locked the customer. Customer is king in business. Customer is king in business. Without customers, you're not in business. So what's the drawback? Again, you require a strong customer trust, very strong, but you're the one who has built it internally by the reputation of an organization. And it may not be visible for all businesses, depending on what portion of agriculture you're in. So that's a short example of that before I jump into the next one, which is debt. So debt, I'll look at it again, like I said, from the angle of short-term debt and long-term debt. And we start with long-term debt, short-term debt. Essentially, we define this as debt, which is normally less than 12 years. And normally we use this short-term debt to support our operations. You want to buy supplies, which will resell seeds. You want to pay seasonal workers. You know, sometimes agriculture, the workers are needed at a certain time, but you harvest after so many months or so many weeks. So you may need debt to finance these employees because they don't know how to live without getting paid. So who offers it? First of all, you can get it from the commercial banks. And we mentioned a few there, like ABSA and Standard Chartered. I think they are, you know, in many parts of Africa. And then we also have this, like a second tier, there are microfinance banks, like we have Kenya Women Finance Trust in Kenya, and Lopo Microfinance in Nigeria, and Agora in Zambia. I think we have some people from Zambia in this webinar today. And then we also have some non-bank financial actors who have come in to bridge, you know, there's so much potential. There's the fintechs, there is the money points, I think, in Kenya and Nigeria, who offer this type of financing to support these credit lines and short-term lending. So how do you access it as a business? Of course, you have to prepare the application and have all the requisite documents, which we will share further along in this webinar. And again, you have to demonstrate a very clear repayment plan. Somebody's giving you their money, you have to assure them they'll get their money back. So what are the advantages? First of all, cash is king. It makes sure you don't get stuck anywhere in terms of running your business. It improves your cash flow. And then they normally have a very quick turnaround because some go as quick as hours. You, especially the fintechs, get on your phone, tap 1, 2, 3. If you have a good record, money is sent to your phone in some parts of Africa. At least in Kenya, I know that happens. So what are the disadvantages? Again, this requires regular repayments and they have interest. And they can be challenging to qualify if the business lacks strong cash flow. Again, let's make sure our cash flows are strong. So there is a typical example of how this would be deployed for a vegetable exporter requiring 50,000. I think some of you have been in this position. You're exporting this crop, you don't have the cash, you need to put it on a plane and go. The plane people have not offered you credit, you're not that good with them. So you have to cough up the money up front, the goods go there, you get paid, and then you pay everybody. And by the time the goods get there, they're verified, you get paid. So that's an example of a short term. In the side of the long term, these are essentially borrowing for the long term. And we recommend very strongly, borrow these ones only when you're doing capital expenditure products, constructing houses, or rather, not your house, a business premise where you're buying maybe equipment, tractors, and equipment like those. And they normally run over 12 months, depending on who you're talking to. So those are the people who offer it. Again, they might be in your country or not, but this is just typical of who offers this type of financing out there. And how do you access it? First of all, you start by a detailed business plan. 90 to 100% of the time, they want to see where their money is going to and how it will come back. So you need all those things ready. And again, demonstrate. He's giving you his money. Money has wings. You have to demonstrate how you're going to pay it. And you also, on your part, can prepare by having an independent valuation report, especially where you're keeping collateral, which we'll speak about later in this webinar, down. So what are the advantages? Again, we start with the good stuff. It may be restructured. Some can understand your business and they say, look, your cash flows come normally in September when you harvest. So you can have a bullet payment in September. The other time is successful management of facility will open you up even to the short-term funding, which other aspects of your business may need. So it is how you play it. It is essentially how you play it out there. So what are the limitations? Again, it requires very long-term planning. The interest can be expensive because you normally pay the interest portion of the facility or the loan before you start paying the principal. So if you are taking it for a short time period, it might not be the best for you. And it may require additional collateral. And we'll discuss collateral later in this webinar. So that's an example where you want to take a loan, a heavy loan to repair over 5 years to build a new pack house facility.
Thomas, just looking at the time, we might need to go a bit more quickly on the remaining financing instruments.
Okay, thank you, Brice. So I'll just jump quickly into convertible debt and quasi. Again, I had mentioned here, it runs from the convertible debt. You can see the definition right there. Because of time, I won't read out all, but the slides will be shared later. So who offers it? Essentially, that's the question many business people have. Who will offer me this debt equity? And there they are. And you can Google some of them. You'll find them. And then the impact funds. These ones are especially coming up very strong. So how do you access it? First of all, showing a strong growth potential and ability to negotiate. Negotiation is very key. If you can't negotiate, please, this can be very, very risky to engage in if you don't have the right tools or the right expert supporting your negotiation. So what are the advantages? First of all, it is patient, and that is what every money wants, patient money, and high likelihood of additional funding if you succeed in keeping to the terms. What are the drawbacks? Potential for ownership dilution and complex terms and conditions. Again, this one, you may need an expert if you're not an expert, just to keep your business lines open. So that is a quick example of what that is. I won't read through it, and I'll jump straight into the direct equity. So what is direct equity? This is essentially selling shares of the company to investors. And again, as we get deeper into this, it's not just saying my company is valued at X amount of money. No, they do their own due diligence before they give you the money. So who offers it? Again, like before, it comes from angel investors and impact funds, which are growing by the minute. And we've shared a few examples there, and you'll be able to read about them when you get the slides with you. So how do you access it? Again, you have to develop a very compelling business plan. Nobody will talk to your business plan talks to the investors and pitch deck. We've seen all these Shark Tanks and other places, people pitching for this type of direct equity. And then you have to network. These things don't bring themselves. You have to keep on networking, get into Khalid. Khalid has resources, network continuously. And then you have to comply with your specific criteria. Again, those are the advantages. I won't read through them one by one. And that is the hindsight. Again, expect to dilute your ownership in the company. So control, if control is a thing, expect dilution to happen. So this is a small example. An agri-tech company raises 1 million to support scaling up. And again, it goes down to valuation. You need an independent valuer for that. The last part of the funding instruments we'll talk about is the grants and subsidies. Again, we start with what are they? These are given by grant makers. and the seed grants are essentially focused on early stage businesses or business life cycles. So those are the people who offer it. Your government may have programs, so watch out for that. Foundations and nonprofits are very good sources of this type of funding options. How do you access it? Again, you have to get in touch with these grant makers, find out what they're doing, and have very compelling proposals. You can find for a certain call for proposals, you have 100,000 people applying. So yours has to really, really stand out. So what is the advantage? It can support unproven business models, right? Again, it goes down to how you put down your story, and there are no repayment obligations. The drawback is extremely, extremely competitive, strict eligibility, and high reporting requirements. Again, this is somebody's money. You have to report and be accountable for how you use it. That's a small example of how that is. You'll read about it when the handouts are shared. So the final one is the matching funds. What are these? This is where a grant provider offers to contribute a specific amount of money for a project, but only if you, the recipient, can match that amount. It might be a 50-50 match or whatever portion you're going to match, often with your own funds or in-kind contributions. Again, as you get deeper into this, you'll understand what in-kind contributions are. So who offers it? Again, like before, governments, foundations, and nonprofits are the big sources of this type of funding out there. So how do you access it? You have to, first of all, have the initial funding or in-kind contribution ready. And again, they are very, very competitive, super competitive. You have to have a compelling proposal. So what are the advantages? Again, no repayment, and then they are very essential for funding commercially unviable portions of your business, where it doesn't make sense normally for you to get a loan or other type of funding. So what are the limitations? Upfront fundraising, very, very strict restrictions, and you must align with the grant maker. And that is a small example out there. A fruit farmer requiring 200,000 to build and equip a storage, and you get 100,000 from a grant maker to support this. At that juncture, I'd like to invite my colleague Harrison to take us through eligibility criteria for different funding instruments. Thank you.
Now that we've understood what the funding instruments are, what exactly do we need as an agripreneur so that you qualify to get this particular funding instrument? To start us off, we're going to look at the eligibility criteria, and lastly, look into the basic requirement for accessing this type of financing. So after looking into understanding the funding instrument, it's integral that now we look into the criteria to get this particular source of funding. To do this, you are going to start with a recap. I think you remember this particular slide from Thomas. He delved deeply into the funding types and looked into the funding instrument from internal financing, debt financing, equity financing, and grant and subsidies, telling you clearly what the funding instruments are below each and every funding type. So now that we've now recapped this, we move forward. What should you as an enterprise do so that you qualify to get this particular financing? As most of you know, you normally say that getting funding, getting agricultural financing is difficult. For me, as a person who raises funds for agricultural enterprises, I know it is not that difficult and it's not impossible to get. It's just a matter of you understanding exactly what you need to do so that you get access to this particular financing. And this is what you want to unpack one by one as we move. To start us off, there is an overview of the different funding instruments. To start us off, we want to look into an overview of the different funding instruments. What are the eligibility criteria for each and every, the most basic eligibility criteria that you need to meet as an agripreneur so that you qualify for this? So we're going to look at 8 basic ones. Number 1, are you formalized as a business? Is your business formally registered? Are you a legal entity? Because as a financier, I will feel less risk financing a business that is properly registered. Number 2, we look into the documentation. How is the documentation like? Do you have all the required documentation for me as an outsider looking in to basically judge how your business is structured and how it is performing? This includes, do you have a bankable business plan? Do you have a proper financial plan? Do you have operational records? Number 3, we look into your repayment capacity. Do you have the ability to repay? Do you have the ability to repay this particular money that you are being advanced. And how do you judge this as funders? We look into things such as the projection that you provided, either through your financial report that you've given to us, also even through the areas of your balance sheet, that the financial statement, the financial segment of your business plan that you already have with us. The fourth vital factor is your credit rating. If you are getting funds, especially if it is not direct equity and also grant, the providers of this particular finances expect that they get their money back. So they are going to look into your credit rating. Are you, as an entrepreneur, trusted to repay this money? What are the chances that you are going to repay the money you've borrowed? And I know for most countries, there are these particular credit rating bureaus that already rank you based on how you've been performing with previous debt that you are provided. The next criteria is collateral. This is so important, especially in cases where you are looking to get long-term debt financing. They'll want to know, what can we hold over you as a borrower, so that in case you default, we are able to cover ourselves by selling this and getting our money back. And most agricultural entrepreneurs normally think that collateral is the only thing that most agri-funders look at. And I can tell you for a fact that somebody who raises this particular financing, it is not. There are various methods we are going to look into that you can implement so that you go around this issue of collateral in case you don't have it. The next factor is business sustainability and scalability. What is the potential that the business has? You as a business person, you want to finance your business with internal financing. Before you take retained earnings and put into a project in the organization, you first of all need to ask yourself, what potential that this particular new venture or this particular new product line that we want to bring to the market has? Will it give us our money back? As an external funder, when you come and you need money for you to, let's say, invest in either OPEX or CAPEX for your agri-business, I'll ask myself, if I look at this particular projection, am I seeing the potential that even if this money is brought in, you are able to repay as you've said? The next vital factor is governance structure. Most agri enterprises, this one I can say for a fact, miss getting finance because they have what we call a high level of key man risk. You are a one person, you are a one man show, as we normally call it, or a one woman show. You are the one who calls all the shots. So as a funder, if I look at that kind of operation, what if something happens to you? Then what happens to the money that I have given to you? Even if I want to give you a grant, this particular grant is supposed to implement a certain project that is going to help very many people. Yet you are the person who makes all the decisions. In case you are out of the picture, what happens to the implementation of the grant that you've been awarded? So governance structure is very, very important. We want to look into, do you have internal controls? Do you know how, do you really understand your operations? Do you know what is the competency of the management team behind this particular organization? If you do that as an agri-entrepreneur, if you have that taken care of, you will definitely be able to access this. The last fundamental factor is the impact. Impact is key, especially in cases where you want to access impact financing, mostly seed grant or matching grant, or even in some cases where you want to access equity funding, or also debt financing from impact funders. So they are going to look into what is the social and environmental impact of the organization that you are running, or even of the project that you want to be financed. So these are basically 8 key factors that most funders normally look at before judging your eligibility to get or to deny you the funding instrument that you have applied for. So now that we have a rough understanding of the 8 major eligibility criteria that you're going to be judged against, we want to look into basically what each and every funding instrument that Thomas took us through looks at in relation to all these particular eligibility criteria. But this is just an overview. I want to just to draw your attention to the legend down there that shows that there's an X. X signifies that these are things that you must have, and the X in the bracket signifies that these are required on a case-by-case basis. I'll take an example of number 5, that is collateral. So when we look at collateral, you'll find that, as you've said before, this is what a borrower gives to be held as security by the financier. If you look at under short-term credits, you'll find that the collateral has a special X, that the X that is in bracket, which means some financiers are going to, some funders are going to ask for collateral, while for short-term credit, while most of them are not going to ask for that. If you look at under convertible debt, also under collateral, here you are going to see here that in convertible under convertible debt, that some financiers are also going to ask for collateral, while in some cases they are not likely to ask you for this because they know this is, after all, this is going to be convertible. But under long-term debts, you're able to see that providers of this long-term debt, if they are not impact oriented, they will definitely ask you for collateral. So after that, we will now move on to now unpack the criteria one by one. Let us now, we saw the first one was being formalized. What does it mean for you as an agripreneur to be formalized? So this, we find that it consists of you being registered and complying with all the relevant regulations in your country of operations. If you want to get a grant, if you want to get a loan, we financiers like to provide loans to people who are properly structured, who are registered formally, so that today I don't give you a loan and tomorrow I find you closed. So why does it matter for you to be formalized? It boosts your credibility, and it shows that you are a stable and a viable business. As a finder looking at you, the first thing I'll ask myself, are you registered? If you are registered, I see you are credible, which means I can finance you. So which source of funding requires you to be registered, be formalized? Number one, we have trade credit providers. As Thomas, I think Thomas did a very good job at explaining who they are. We have customers who are making prepayments. If I'm making prepayments of, let's say, $500,000, I need to make my prepayment to an entity that is legally registered, that in case of anything, I can even move to court to claim, to get compensated if at all you do not supply, you do not deliver. Banks and microfinance institutions are also key when it comes to looking into you being formalized before they can even transact with you. We have impact funds, equity funders, grant makers, and also government agencies. All those are, they pay close attention to you being registered or you being formalized before transacting anything with you. So as an agripreneur, as an agri-MSME, how can you prepare in regards to being formalized? As you know, since you know, it's a very wonderful, it's a very, very major criteria. Number one, you need to legally register your business and obtain all the licenses and registration required. Number two, you need to ensure that you comply with all the local regulations and standards. So as a takeaway to this, we are seeing that you need to ask yourself, is your business registered as a legal entity and recognized by the law in the country in which you are operating? If the answer is yes, then it means you are likely to pass that particular criteria. So the second criteria is documentation. So what does it mean when you talk about documentation? This just basically refers to how you are recording, organizing, and storing information that are related to your business. These funders that you are seeking their support, they are outsiders looking in. They do not understand your business as you do. The only thing that will enable them to understand your business is the interaction they are going to have with the documents you provide to them. You won't be able to provide this documentation if you are not keeping proper records, if you're not organized. So what are some of these documents that they are going to look for? Number one, a business plan. Do you have a robust and a bankable business plan? Can you produce accurate financial records? Are these records, have they been certified? Are they okay? Are the projections realistic? Do you have operating manual so that I know, like this particular business has got let's say a tool to sign bank mandates, which means no one person can resign to just up and run with the company resources. If at all, we give them a loan. So why does it matter? As I've said before, this document helps you communicate with the funder that you are approaching. Number two, this document also helps establish not only trust, but also credibility, so that we've seen you've been performing like this for the past 2, 3, or even 1 year. I'm able to see that. I can also now judge from that. Who requires this particular documentation? Who requires you to have the documentation ready before they can even decide to qualify you to get funding? Number one, we have trade credit providers. We have customers who are providing prepayment. They want to see how is your record been like when supplying other people, so that if I give you my money, it's not going to disappear. We have banks and microfinance institutions. We have impact funders. We have equity funders. Before you get any equity into the organization, definitely you need to show me how you've been performing in the past so that I can project how likely you are going to perform in the future. Grant makers want to see what were your sales, what was your turnover last year, how many people were you able to reach. So that kind of documentation will help them decide whether or not you qualify for the grant you are seeking. So how can you prepare as an agri-SME? MSME, you want to get this particular funding in. You have approached somebody, you want either loan, equity, or grant. How do you prepare? Number one, have a well-maintained financial record. Number two, maintain updated standard operating procedures and manuals. It is very important so that I know you have a properly defined way of operations within your organization. You don't just wake up today and tomorrow you've just moved. Number three, have third-party verified records. Like for instance, audited accounts will help me prove that these accounts have been looked at by a third party and they are certified to be true, a reflection of how the company is performing. As a takeaway for this particular slide, can your business records speak about your business current events and also how it is likely to perform into the future? That is the only way you're going to communicate with third parties, through business records. The next one that is very important is ability to repay. This is your repayment capacity. If you provide, you approach especially providers of debt, they are going to be very keen in looking into, does this business have the ability to repay? They are going to judge that by looking at your cash flows. For instance, you're a business that you want to borrow that earns approximately $5,000 every month, and you have to pay a $3,000 in debt each and every month. From what you're earning in and what you're supposed to pay, the banker is going to judge, okay, from this particular cash flows, I'm seeing the ability to repay is here. So this one is basically judged by looking at your cash flows as a business. So why does it matter for you to prove ability to repay? It lowers the perceived risk for the lender. The lender will feel comfortable providing this particular facility to you because they know you have the ability to repay it. And if I see that you have a very heavy ability to repay, interest rates are normally negotiable. You are going to get very, very favorable terms if your ability to repay is very high. But if your ability to repay is very low, like by looking at things such as your debt to equity ratio, you are likely to get very, very negative terms, very, very unfavorable terms when it comes to getting this particular final instrument. Who offers this? Who requires this? Which source of funding requires you to have repayment capacity? Basically, everyone who provides you money that is supposed to pay back, they are going to look into your statement. They are going to look into your cash flows to judge whether or not you are able to repay. How do you prepare for this? You prepare by having an updated cash flow statement and cash flow projections that are able to show positively and not also over optimistic projections where your business is heading into the future. You need to also gather third-party support documentations, a bank statement. If I look at a bank statement, I'm able to judge exactly how your cash flows look like. Supply contracts will able to show me exactly how you are going to perform going into the future, and also audited financial reports. So as a takeaway, you need to ask yourself as an agri-MSME, can your business cash flow adequately cover its financial obligation? If the answer is yes, be rest assured that when you are approaching various source of funders for the various instruments they are providing, they are going to consider you positively. The next vital criteria is credit rating. This one basically speaks to how you've been paying back the debts that you've been accorded by other people in the industry. So as a bank that you've approached, I want to see that you took a loan, let's say from Standard Chartered Bank in the past. Did you repay that, or you failed to repay that? And even if you repaid it, how did you make the payment? Did you make the payments on time? So if I see that, I'm going to use that to judge your credit rating. So if you have a high credit rating, it's going to boost investor confidence. They're going to see that this is an entrepreneur who understands his or her financial obligations and meets them exactly when they fall due. It will signal to me that you are a low risk. The likelihood of you defaulting is very low. And in fact, if you have a very, very high credit rating, you'll find that even for people who normally ask for collateral, in your case, they are not going to ask you for collateral because they know you are a responsible business person who makes their payments on time. Who requires you to be credit worthy by looking at your credit rating? Everyone who provides debt, be it trade credit providers, customers, microfinance, convertible rate providers, they will ensure that they want to deal with a person who has a very favorable credit rating. So as a business, how do you prepare as an agri-business? ensure that you meet all your credit obligation. Ensure you meet all your credit obligation as soon as they fall due, so that you have a positive payment history. So as a takeaway, as an agri SME, ask yourself, when is the last time you accessed your company credit rating? And from your local rating agency, is it a poor rating or is it a high rating? If it is poor, you need to put measures in place to start, remedial measures in place to start correcting what is there. The next vital factor that you need to consider for you to qualify for funding is collateral. So these are basically assets that you offer a lender that they can retake in the likely event that you are not able to pay. They include things that, let's say, machinery like tractors, the farmland itself, and maybe account receivable that you have. So why does this matter? As a lender that you've approached, if you have collateral, they see the perceived risk for them is now very, very low, and they'll be more than willing to provide you with the funding instrument that you went to seek from them. But you also now need to note that it is not always, there are always methods of mitigating the requirement for collateral, especially in the agricultural sector, by providing these people out of the 8 eligibility criteria. If you meet 7 out of 8 and you do not have collateral and your documents are able to speak for themselves, this particular source of funders, especially the debt providers, they are in the business of also selling money. The same way you are in the business of selling agricultural products. It's just a matter of now how you convince them to sidestep and overlook this issue of collateral. I've done it several times. It is possible. So which source of financing will require collateral? This one are mostly banks and microfinance institutions. But for banks and microfinance, they look for this, especially in cases where they're providing long-term facilities. Impact funders will rarely ask you for collateral. They'll ask you for collateral only in cases where you are a very high risk. But in most cases, the impact that you're doing outside there is what will stand in this instead of the collateral that you are not likely to be asked for. So how can you prepare? Ensure you register your assets in the name of the business. For some people, normally when they come to me for fundraising, you find they have a business, a land that they're using to do business, but the land is registered in their name or in the name of maybe their spouse, and the business has a different registration. In such kind of cases, it becomes very complicated for the funder to link the collateral to the business that is seeking financing. Also, keep appraisal of the value of the asset current. Every time ensure that you do valuation so that they see, my land, I bought this land in 2020, I've been having it for 4 years, it has appreciated in value to this much. I bought this vehicle in 2010, it has depreciated by this much. This is the current valuation of the vehicle, so that you know exactly how much you can get by the collateral you have. So as a takeaway for this particular criteria, you need to ask yourself, can you identify assets in your business that can form collateral that you can offer to the prospective financiers, the protective funders that you're likely to approach? The sixth one is scalability potential for the business. You are an agribusiness SME. What is the potential for scale that that business have? Does this have prospect for future growth? So as a lender, I'm going to look at your current sales and future growth plans to decide whether or not you could qualify for the loan or you can qualify for the grant. You want a grant and currently your turnover is maybe $50,000. From the projections, if I give you this particular grant, will this turnover reach to maybe $100,000? Which means if it goes to $100,000, you are either providing affordable and nutritious foods to more people outside there in the market, or you are aggregating from even more farmers, which is good for me as an impact financial. Why does it matter? It signals a positive outlook for repayment in case of debt, and also an outlook for high impact, as I've said, in case of grant financing. So who requires this? Everybody, mostly every person, even you yourself, before you reinvest money that the business has made into the business. You need to be sure that the venture you want to finance with retained earnings will generate more income. Even you'll consider that. Customer prepayments will consider that. Banks and microfinance impact fund, basically everyone will look into this particular criteria. How do you prepare? You need your current business plan. And the business plan needs to show in the projection that this business is deploying a scalable model. Number two, you also need to validate research and development to support these assertions. If you say that my sales are going to increase by 30% in the next financial year or in the next quarter, what are you going to do differently to ensure that these sales get to that 30% increase? What is your takeaway from this? Are your projections for growth realistic? Don't just provide me projections that are so much optimistic that even me as a third party looking at them, I say, okay, this is not attainable. Be very conservative and be realistic with the projections that you provide outside there to back up your ability to scale as a business. We look at governance. The second last criteria for you to get this particular funding instrument is governance. What is it? This regards the framework, process, and rules that you as an agri-SME, you've defined for the organization, how it operates and how you make decisions. Do you have a board of directors? If you are so big, you need to have this. If you are small, do you have an advisory board? Do you have an executive management team? And what are their qualifications? What are their certifications? What policies and procedures do you have in place to ensure that you are providing safe food outside there, to ensure that you are providing food or products that are not going to be rejected in the market that you are exporting to? So that is a fundamental part of the governance structure. Why does it matter for me? It matters because effective decision making reduces risk. If you are a one-man show or a one-woman show, there's a lot of key man risk, but for me as a financier, if I look at that particular form of business. But if the business, maybe you are a one-man show, but you have an advisory board, which means the risk has now been mitigated. So it is this particular small things that normally make you receive no instead of getting a yes. You can say, I'm a sole proprietor, but I don't make decisions alone. Every decision I make, I have to run it through my advisory board. For now, I don't have a full-fledged board, but I have an advisory board. The financial will look positively at you. So who considers this? Number one, banks, especially for long-term debt, convertible debt providers, impact fund. They want to see who is involved in this, and do you have the policies and procedures set in place. Equity investors. Equity investors will not come into a business that is not properly structured. And also grant makers. Grant makers also always want to mitigate the risk of the grant they provide being misused or even misallocated. So they'll want to see an advisory board. They'll want to see a fully fledged board, or they also may want to see what? A management team that is competent. So how do you prepare for this? You need to have a diverse and experienced board, either advisory or a fully fledged board. You need governance policies. How are your policies in finance? How do you hire? How do you fire? How do you access company funds? You need to engage competent and experienced management team. I want to see that the accountant you've hired is not only your brother-in-law, but the accountant, even if they are your brother-in-law, they are competent. They're supposed to be in that particular position. I want to see that the farm manager that you have in place, this particular farm manager is experienced in looking after tomatoes. I don't want to see a farm manager who has something maybe in mechanical engineering. They don't understand even how crops are supposed to be taken care of. You only hire them either out of pity or being a friend, or they are also maybe a relative. So we want to see also attendance on topical training on governance. Attend this particular session so that you know exactly how you have a properly structured governance structure within the organization. So as a takeaway for this particular criteria, ask yourself, is your business in safe hands? Are there guidelines for operations and management? And what is the certifications or the qualifications of this particular management team? And lastly, the last criteria. This is vital for those of us who seek either grant or patient capital. It can be debt, but it can be patient debt because we're getting it from what? From impact fund providers. Number one, are you providing a positive social and environmental outcomes? So if you're busy, if the answer is yes, kindly start approaching these guys. Number two, why does this one matter? Apart from generating profits, because the business is supposed to generate profit, you are a social enterprise that is also positive, also keen in ensuring that you leave a positive impact on the environment and also on the lives of not only your employees, but also stakeholders around the business. So which source of funding requires this? Banks, but for bank, when a bank will ask you for your impact, especially in cases where they want to finance you a long-term investment, maybe you want them to give you money to build a pack house. They are doing this to ensure that you have all the required certifications so that the regulation bodies in your country are not going to close you down due to pollution or such kind of things before you fully repay them. But for impact fund, equity investors, and grant makers, these people who are aligned, if they are aligned towards positively impacting the lives of people, maybe in Africa, ensure that Africa is food sufficient, you are able to get this. As a fundraiser, I've leveraged a lot of impact fund for my clients. And some of those debts are really good. They are not only patient, the interest rates are very low. Some of them even have 0% interest. And the repayment period is very okay. And they also give you moratorium, but that follows the cycle of the crop that you are doing. So it's a very good source of funding instrument that you need to consider. How do you prepare for this? You need to implement high impact and inclusive business models. And impact financial is not going to give you money if your business model only benefits you. You need to have inclusive business model that benefits everyone, you included in it. Number two, you need to embrace environmentally conscious business and production practices. If you are someone who likes pollution, definitely count yourself out. So as a takeaway for this criteria, the last one, ask yourself, can I make a strong case for the positive impact my business is making in promoting social good? If the answer is yes, run and start approaching the social fund providers that are in this slide that you saw Thomas describe. So after understanding, after properly unpacking what you require as the criteria. So each criteria comes with a set of documentation that that fund providers use to judge whether or not you are qualified. For instance, when you want to talk about you are formalized, I'll ask you, can you provide for me identification documentation, both for the company and for the owners of the company? Provide certifications. You are exporting. Are you certified to export? Do you have business permits and licenses to operate? Provide for me all compliance documentations. When it comes to looking at your documentation now, we want to see audited accounts. We want to see financial projections. We like to see your list of debtors and creditors. We want to see management accounts. And the same in this slide as the same with the previous one, you see the X talks about what you must provide. For instance, if you are talking about, let's take an example of, let's get a pointer here. Let's take an example of long-term loans. You see, for documentation under long-term loans, you need to provide all those documentation for them to assess your eligibility. On the other hand, you see, under trade credit, you only need to provide formalized business records. Formalized document that provide to prove that you're formally registered. They don't ask about all this documentation. They don't about capacity repay in very few instances. So that is it. These are documents that you need to back up. You need to look into as you try to judge whether or not you are eligible for the criteria that you are looking at. The same to this other slide. You are looking at collateral. What are they going to ask for? They're going to ask for collateral security. Do you have it? Do you have signed guarantee forms? You are the directors. The directors are supposed to guarantee this particular debt. Impact providers are going to ask you for social impact report. They're going to ask for environmental impacts report. But as a disclaimer, these will vary depending on the jurisdiction in which you operate. So on whether people in Kenya will have different regulation requirements from people maybe operating in Togo or even Malawi, but to a larger extent, they are going to largely remain the same. So now that we have known what you need to do to be eligible for the funding, various funding instruments that are provided outside there, we are now going to look into the next steps. What are you supposed to do? Number one, we are going to recap into the key takeaways from this and then look into the practical tips. And then the next step that are going to follow, both from you as an entrepreneur and also from Collead, because they have a lot of resources that are going to guide you now that you understand this. Where should you now take this information in your journey towards accessing funding? So as a takeaway, just a reminder, a recap of what we are planning. The first source of funding that we look at is the agribusiness itself. So as an agribusiness, what kind of funding can you provide yourself? You can get internal revenue, you can get reinvestment, and also even partnership. So the funding instruments are what? Number one, profits and retained earnings. We have the trade credit and customer prepayments that agribusiness can get for itself to finance its operation. You should not always rush to getting loans because loans are expensive. You should first of all consider whether this money, you can get it internally. So what are the main criteria? Consistent profitability, as Thomas explained, a relationship with suppliers and customers, also a strong customer trust. If people trust you, they are likely to give you. I have clients right now I'm supporting who get credit as high as even $30,000 worth of credit from people who supply them with fertilizers. So you need to have that particular trust. Number two, main source of funding, we have commercial banks and microfinance institutions. What is their approach? So from commercial banks and microfinance institutions, these are people who maybe mostly they provide debt financing. So short-term debt and long-term debt. What are their main criteria? Credit history, and in the case of long-term debt, your ability and capacity to repay. So for short-term loans, you get loans for OPEX. These are loans for operational cost. For long-term loans for CAPEX, let's say, for example, purchasing of a new equipment. We have impact funds. As I told you when I was presenting, impact funds are very, very good for agri-SMEs. Number one, they are cheap. Number two, they are very patient also with you. So what is the approach? We have equity and debt financing. They can provide long-term debt investments, and also they come with technical assistance. They give you a loan, and on top of that, they provide you technical assistance for you to get certification that's for able to maybe export products to the European market. So what kind of instruments do they come with? They can come with either debt or equity or convertible debt that you can convert into equity depending on how your business is performing. So when it comes to convertible debt, they're going to look at high growth potential and willingness to share future equity. So if your business is implementing what we call an inclusive and a very impactful business model, and it has got a very good growth prospect, they're likely to get you convertible debt and see whether or not you can give them some form of equity, even instead of paying the debt. So when they come in with direct equity, they want very scalable and high potential and also high impact business model. So for as we said, in the case of loans, they want you can get this money for operational costs and also for capital cost. Lastly, we have grant makers. These are non-governmental organizations, government programs, and also impact funds provide this. It comes in the form of seed grants and matching funds. For seed grants, you need to have a very innovative idea with the potential of significant impact. You are coming up with a way of maybe making, let's say, food easily available and accessible and affordable for consumers, agricultural products. They are likely to give you seed grants, or maybe you are innovative in terms of sensors to ensure that farmers not only just blatantly apply fertilizers, they apply fertilizers only to identify a specific deficiency in the soil. They can give you seed grants for that. We have matching funds. You want money to make, for instance, give your outgrower scheme. Let's say you want to give them seeds because you have a particular seed type that you want to give them to enable them produce the quality you want to aggregate in future after the products are ready. They can say, for me, I'm able to provide X amount of money. Maybe I'm able to provide $100,000. Can you kindly match this in the ratio of 1-to-1 so that I'm able to give the farmers these seeds? I do that a lot, and it's really possible.
Yeah. Thanks a lot. Thanks a lot, Harrison, for explaining all the eligibility criteria in detail. I think it was very valuable what you shared from your experience. So that was it for today. As you can see on the slides, today was the second episode of this series. This series of webinar is intended at increasing your chances of finding the right funding opportunity for your agribusiness. Know that you are all pro in understanding what are the different funding instruments available. You may be asking yourself which one is the relevant one for your specific project. Well, this is exactly the topic of the next episode in February. Please make sure to check your mailboxes. You will all be invited to this webinar. And then the last one of the series is going to be about how to practically and concretely engage in a conversation with those sources of funding. So how do I talk to a bank? How do I talk to an investment fund? How do I talk to even a private equity fund? So how do I come up with a pitch deck, for example? How do I initiate a due diligence? So these will be topics that we will be covering in the last episodes of the series. So this was very specifically on access to finance. As you know, CoLead provides trainings and webinars to help agripreneurs improve their business skills and be more prepared for accessing finance. So on the left-hand side, you can see we already have a lot of material that is out there in terms of webinar on our YouTube playlists, but we also provide trainings. So these are e-learning trainings that you can do independently on your own on all these topics. So business management, financial management, marketing, communication, HR, commercial and financial risk management. So all these topics you're able to learn in independent self-study courses of approximately 4 to 6 hours on our platform. Rest assured that you will receive all the material by email. So the cheat sheets that you've seen, the overviews that you've seen, also the detailed program. So this you will receive by email before end of the week. Thank you for your attendance today. Thank you for your patience. We went over time a lot. Sorry for this. We hope it was still valuable for you. I want to thank Thomas and Harrison for their help in delivering this and preparing and delivering this webinar. Also thanking the colleague team with Henri and Waiting who participated preparing this presentation. And now we have a very short time for Q&A. So if there is a specific question, we have time to address 1 or maximum 2 questions. Feel free to share them in the chat or in the Q&A. We have already answered some of the questions in the Q&A. So I see one question that is coming up right now. I created my company last month. Can I be eligible? Yes, you can be eligible. You will be able to access the application form. The link will be available in the follow-up email. There was one question about how about business advisory services for improving my chances of raising funding. Maybe Harrison, if you could answer this one. I already answered
Yes.
in a written way, but maybe based on your experience.
Yes, based on my experience, business advisory services play a very fundamental role in ensuring that we're able to access funding because the business advisory providers already have a clear understanding of what funders, whoever you are choosing to approach, wants to see. So they're going to tailor-make your business and going to tailor-make your documentation in a way that when you provide them to the actual person you're supposed to approach, there's a lot of congruence in communication between what they want to see and what you've provided. And in these cases, as we have seen, because we are doing this practically in Kenya right now, it increases your chance of getting financed by almost maybe 100%. So as the same as we are doing this in Kenya, there are local business or service providers in your country who do the same thing. So if you want to get financing and you don't know where to start, it's advisable that you seek them in your local jurisdictions to ensure that they help you through this particular process. And it's not expensive. You just need to negotiate with them that I'm not paying any upfront fee. I'm going to pay you success fee on what you have raised. So the issue will be just discussing what percentage of success fee am I going to pay you? Is it 1%, 2%, 3%, and so on, as much to a level you are comfortable with as an agri-SME. Thank you so much for that. And I've seen another question here that I'd like to tackle. Can you get this money? Maybe you are from Nigeria. Can you get a loan from overseas? Yes, I've fundraised a lot for people in Kenya from overseas loan providers, maybe in the US or in the UK. When Thomas was presenting, there was a bank, one of the social impact banks that was there called Rabobank. They're able to finance you regardless of where you are in the world. As long as the financing you are seeking for has an impact, is impact oriented, and you are operating within the value chains in which they are operating in. So it's possible for you. That was from Dakorubo. It's possible to get financing.
Great, thanks a lot for the input. Maybe a very small last question. So kindly share the chances for sole proprietorship for funds. So is the fact of being a solopreneur any barrier to raising funds?
No. It's not a barrier to raising funds because a business must start from somewhere. So as a sole proprietor, you just ensure that you meet all the 8 eligibility criteria that I've stated. And also you just tailor-make them depending on the source of fund you are approaching. Is it a commercial bank? Is it a debt financing? Is it equity or is it grant? And after looking at that, what particular instrument are you looking for? So whether or not you are a sole proprietor or you are a limited company, even a partnership, there's not a limitation for accessing financing.
Great. Okay. Great. Thanks a lot. Thanks a lot to the audience for their questions. We will close the session now. Thanks for your feedback. Please share your remarks, suggestions, ideas in the forum. We will really appreciate them. Thanks for your attendance, and we look forward to meeting you again in the next webinar. Thank you.